Welcome to this week's market update, where we review the key developments that shape markets, highlight what drove our recent performance, and look ahead to important events on the horizon. Let's start with what moved markets this past week. The big story was a healthy pause in stocks after several strong weeks, as investors took time to reassess company earnings and spending plans. Technology shares led the pullback, but this is a natural part of market behavior after the strong gains we have seen recently. What is important is that the decline was orderly and not panicked. That tells us that investor confidence in the economy remains relatively intact. For our portfolios, this kind of environment actually plays well into our strengths. Companies with reliable earnings and solid foundations tend to hold up well during these adjustment periods, which is exactly the type of business we focus on owning. One of the week's biggest stories was Amazon's announcement of major new investments in artificial intelligence and digital infrastructure. While the stock market reacted to the near-term cost, Amazon's leadership expressed strong confidence that these investments will pay off significantly over time. We are seeing similar moves across large technology companies, all betting heavily on AI capabilities. The market's reaction reflects timing concerns and not doubts about whether these technologies will succeed. For long-term investors like us, companies building competitive advantages today are positioning themselves for years of future growth. On the economic front, weekly jobless claims showed a temporary increase, largely driven by severe winter weather disruptions. Looking past the weather effects, the broader employment picture remains relatively solid. Employers are showing restraint rather than widespread layoffs, which does support continued economic expansion. A stable job market means consumers can keep spending and businesses can keep generating profits. Staying diversified remains the most effective way to navigate short-term market noise, while also capturing long-term growth. Now, let's focus on what drove our performance over the past week and why we remain confident in our portfolio positioning. Merck was one of our strongest performers, rising 10.5%, as investors recognize the value of owning high-quality healthcare companies. These companies perform best during times of economic uncertainty. Merck combines two qualities that we look for in every investment: a strong current business with predictable revenue and a robust pipeline for new products and future growth. Unlike companies that are more directly tied to the economic cycle, Merck's healthcare focus means products remain in demand regardless of broader economic conditions. This kind of resilience is exactly why we hold it in our portfolios. The consumer staples sector led our performance last week, with strong gains across nearly all of our portfolio holdings. Walmart rose over 8%, while Costco, Procter & Gamble, Coca-Cola, and PepsiCo also contributed solid returns. These companies sell products that people need every day, giving them consistent demand and strong pricing power. Cost pressures have also been easing, which means that their profit margins are improving. Consumer staples provide an important anchor in our portfolios, offering predictable cash flow, earnings, and dividends that help smooth out the returns during volatile periods like today. Our value strategy was the week's strongest performer, with holdings offering attractive valuations and strong cash flows, significantly outperforming in a period of unrest like today. Verizon led the way with an impressive 18.3% gain, while Merck, AT&T, Amgen, and JP Morgan all delivered strong returns. This highlights something important. Investors are increasingly rewarding companies with tangible financial strength and reasonable prices. During periods of reassessment like today, businesses with visible near-term profits and solid balance sheets attract significant investor interest. Our value holdings play a critical role in managing risk while also helping us participate in market gains. Looking ahead, here are the events that we are monitoring that could shape markets in the coming week. Wednesday will bring the January jobs report, which was delayed from last Friday by the brief government shutdown. Economists are expecting around 60,000 jobs were added in January, following a similar pace in December. This report matters because employment is the foundation of consumer spending, which does drive about 2/3 of the economy. We will be watching not just the headline number, but also the wage growth and the labor force participation, which will give us clues about where the economy is headed. A stable employment picture would be reassuring for both stock and bond markets. Thursday morning's weekly jobless claims number will help us gauge whether the recent spike to 231,000 was truly weather-related or the start of a new trend. If claims return towards the recent range of 200,000 to 210,000, that would confirm the weather explanation and also signal continued labor market stability. This weekly indicator is one of our most timely tools for spotting emerging trends before they show up in the monthly reports. Friday also brings the January Consumer Price Index number, also delayed by the government shutdown. This inflation report tracks what Americans pay for everyday items, from groceries to healthcare. The recent annual number came in at 2.7%, still slightly above the Fed's 2% target, but well below the recent peaks. This data is particularly important because it could shape expectations for when the Fed might start cutting interest rates again. Lower readings would support the case for rate cuts, while higher readings could add some near-term volatility in the market. Either way, it helps us position our portfolios effectively. As always, we remain focused on what matters the most, helping you achieve your long-term financial goals through disciplined investing and thoughtful portfolio management. Thank you for joining us, and we'll see you next week.